Hey, on today's show, for those out there, we want to talk about how to insure your mortgage debt. And if you think about mortgages this way, you know, Jason, what's a person's biggest asset? Would be their home. What's the person's biggest debt? Would be their mortgage. But what's amazing to us is, and we still see it every day, that most people don't understand how their mortgage insurance works. So I can kind of paint the story. Everybody's ambitious. Home sales are going through the roof. You do your deal. You're excited. You talk to your mortgage person, either be at a bank or at a mortgage brokerage firm. And one of the questions is, hey, do you want to insure the property? I mean, it's amazing how many folks improperly insure it.
Yeah, absolutely. It as you mentioned, it is their biggest debt, their biggest asset. So it is the number one financial planning tool that we talk about. You have to insure it.
And on today's show, what I want to get into is we've come up with about 8 to 10 different reasons why it makes more sense to you and your family to insure the mortgage, the debt with an insurance company, a traditional insurance company, one of the big ones, as opposed to buying it through your group lender contract. But one of the first points here I want to get into, Jason, is, and again, I didn't know this up until a few years ago, was how little banks would insure. So I'll give you the example. The number one feature here on the insurance is when you go to a bank right now or a lender, the maximum amount of coverage you can get is between $600,000 and $1 million. So imagine this. That was a lot of money to insure 5, 10, 15 years ago. But in today's world, you know, $1 million mortgage is a starter home, and you're looking at $1.5 to $2 million mortgages. So if you pick a lender that only has a cap on their debt ratios at $600,000 or $750,000, you're severely underinsured. Whereas the insurance companies will insure up to $20 million.
Well, isn't the average price of a home now about $800,000, $750,000, $800,000? So it's not far off from that $1 million to not be insured. So.
Yeah, so it's just amazing. Yeah. I can't imagine. You know, you're in a great city, Toronto, Vancouver, even down here in Niagara, and you go and buy a $1.7 million home. You put down $300,000 on the mortgage, and you're down to a $1.5 million mortgage, and yet you don't realize that you're only covered for $600,000, $700,000, right. $800,000.
Yeah, that's right. One of the other product features, differences between the insurance companies and bank insurance is the death benefit payout structure. So basically, how much is going to get paid out if, God forbid, something happens to the insured? So with a typical insurance contract through one of the major insurance companies, you apply for $1 million of coverage, you're going to get a payout, or your beneficiaries will get a payout of $1 million. So we know exactly what the coverage is for. On the flip side of it, with the bank insurance, if the mortgage is down or if you have an insured line of credit, we don't know exactly what the payout's going to be. It could be more, it could be less. That's a recipe for disaster. And at the end of the day, only the banks are the ones that are going to benefit from this.
Yeah, and the other big thing too is that you buy your house, you have a mortgage, let's call it $500,000, and then over 5, 10, 15 years, you've paid down your mortgage as a good payer of the mortgage. The mortgage balance is $100,000 at your bank or at the creditor lender, and then the person passes away, and you know the person gets a check for the balance owing, which might be $50,000, $80,000, $100,000. On a traditional insurance policy, if you applied for $500,000 in 5 or 10, 15 years, the person dies, you're going to get the $500,000. The third big thing on the differences between buying insurance through a traditional insurance company and a bank or a mortgage lender is the medical underwriting. So what happens with insurance companies is you make the application, we ask all the health questions up front, we do all the medicals up front, we may do blood work, we may do a urine sample, that type of stuff. But you know when you get that contract, it's a black and white contract. You've got that contract, it's in place. The bank lender does the underwriting on death. So you sign a few boxes off, you're temporarily covered. You're covered, obviously, you pay your premium, and then at some point you die, and then what happens is the bank or the lender starts to do all of their due diligence to see if you do qualify for the claim.
Yeah, most people don't realize that the bank mortgage carrier could potentially write the doctor to find out was there a medical history for that person that passed away. Whereas, as you said, with a regular typical insurance contract, once you're approved and you've applied for your insurance and you're approved, it's over. That's what the payout is.
Guaranteed.
The other one of the other features, of course, is refinancing. So when you're dealing with a typical mortgage insurance, a mortgage is usually a 3 to 5 year term. If that's the case with bank insurance, you're going to have to refinance your mortgage and reapply again for your mortgage. Whereas with a typical insurance contract, once you've been approved that day, you don't have to worry about worrying about reapplying for any insurance.
Yeah, and the other big point too is that what if every 5 years you want to shop your mortgage around? So you get your mortgage with a lender today, and it's a 5-year plan. It's a great deal, but then in 5 years there's a better deal to go somewhere else. You move your mortgage around, you have to reapply for the insurance. With insurance companies coverage, it's a portable suitcase. You take it with you from lender to lender to lender. Number 4 here on some of the benefits of how to best insure your mortgage debt is the coverage, right? So again, we go back to it. The bank lender, the mortgage lender, it's a decreasing term coverage, 500, 400, 300, 200. And what you can do with these insurance companies is you can build in a term where for 10, 15, 20, 25 years, that coverage will stay level. So again, if there ever was a, God forbid, death and there was a payout, the difference between what's owing and what was applied for is going to go back to the spouse or the kid. So it's a much better way to protect your mortgage debt.
And by the way, with the bank insurance, you're still paying the same premium, even though the cost or the amount of the insurance is going down.
For somebody who's healthy right now, it's a huge deal. If you're healthy right now, it's much less inexpensive than if you go to a traditional bank. If you're in poor health, I always say if you're healthy and you're a non-smoker, you should really look at using the insurance companies. If you smoke 6 packs a day, drink a bottle of scotch every day, and you're 400 pounds, you may be better off going to your bank lender for that coverage.
Yeah. The insurance companies on a typical insurance, they might rate you, medically increase the cost of the insurance, but on the other hand, with the bank insurance, they'd probably deny it at some point.
Yeah, one of the big issues is that if you have cancer and you go to apply for a bank insurance, it may say right there, have you ever had cancer? Yes or no? Yes, I have. You're denied. With insurance companies, depending on the severity of the cancer, you could reapply 5, 6, 7, 8, 10 years down the road and still have a policy. If you've had a health condition, a heart condition, some diabetes, whatever it may be, where you may be declined at a bank, we can still get you a rated policy. So even those that are not in the greatest of health, that have been declined by a traditional lender, we can get that for you as well. Next key point here is for those that are doing self-directed mortgages and second mortgages. You do a second mortgage, you end up borrowing another $100,000 from a second mortgage carrier. You're not going to get insurance through a traditional bank or a lender. But with the insurance companies, Jason, it happens a lot now is people are going out and they're over-financing their homes and they're over-leveraged and they don't have the down payment and they have to go into a debt position with a second mortgage for a year or two. At least with traditional insurance companies, we can best protect against that second mortgage or that self-directed mortgage.
Yeah, one of the other product features is when does the coverage end for life insurance? So with a typical insurance company, we can have insurance coverage end at age 100. With banks, unfortunately, it ends at age 70. So again, bank coverage ends at a time when you might need it the most at age 70 years old.
It's a great point, right? You think about today. I mean, people going through second marriages, second lives with new spouses, and you're 60, 65 years old. Maybe you do want to upsize your debt and with your new partner. And obviously, if you're in your 70s and you've got insurance, then the bank, then it's not going to be able to be paid if you pass away. Next key point is coverage portability. As I always say, when you buy through an insurance company, it's like putting it into a suitcase. You've got your $500,000 contract. Wherever you go in the next 5, 10, 15, 20 years, you can take it with you. If you go through a traditional lender, a bank insurance, anytime you change, you're going to have to reapply at a higher rate. and also answer some of those health questions.
Yeah. Another feature is estate planning convertibility. So again, with typical insurance contracts, you can change, alter, convert any up to any age up to age 75. With bank insurance, of course, there's no options. So again, your needs change as you get older with life insurance, and most people think they might need it when they're getting older, but it's not always the case.
Yeah, and one of the big things too is that you get to the point, maybe you've insured your rental units, you've insured your cottages with the insurance company insurance, and then what happens down the road is you realize there's a huge capital gain. The policy you bought to protect the mortgage maybe is no longer required, but at some point you might say, hey, I want to change that plan over to a plan that's going to cover some estate tax or some capital gains. So we can do that as well. Number 9 point here is restrictions on multi-unit coverages. So again, if you buy it through a bank or you buy it through a traditional lender, it's typically 1 to 6 units maximum. So if you're buying a 5-plex or a 6-plex or a 4-plex, you can still get the insurance through a bank. But what if you're buying a 10 or 12-plex, right? You can't get it through a traditional lender. We can insure up to any amount of space. So if you were buying an apartment building with 250 rooms, we could look at putting the insurance on place for that mortgage as well.
Yeah, and the final key point is pricing. You had mentioned it before. If you're healthy and there's really no medical issues or any family history of any medical diseases or any conditions, there's a good chance that if you applying for life insurance through a regular company, you're going to get better rates than if you're dealing with the bank insurance.
And I can say right now is for the first 3 months of 2022, we probably did about 8 to 10 mortgage insurance contracts. We had some of our mortgage partners call us that obviously do mortgages, and they wanted us to do the insurance. And every single case, Jason, we actually gave them better features, better benefits, better plan, and saved them all premium. So we were really happy with that. So if you're out there right now and you're looking at buying your biggest asset, your most valuable asset, or maybe your biggest debt, make sure that you get some advice and some understanding of how bank insurance and mortgage insurance works through either the bank, the lender, or the insurance companies. If you're out there and you want to check out our podcast, Jason, they can see your beautiful, good, charming, good looks. As I always say, George Clooney, good looks. We have the It's Your Wealth podcast. It's on YouTube, and again, you can also subscribe to the podcast edition.